Hello everyone, welcome to Brilliant Bankers. In today's session, we'll be discussing about Module B, that is General Operations or General Banking Operations in the paper, Principles and Practices of Banking for our JAIIB exam. I can assure you, if you are able to answer more than 50% of the questions in this, you will be able to clear the paper. That is 50% of the questions in Module B. And you can continue following me so that you get the other parts also, that is Module C and Module D of PPB. So let's start off with the first question, and there will be explanation for each and every answers also. Let's start off with the first question. A bank sanctions a loan to a new business without assessing the capacity of the borrower to repay from the business cash flows. Which fundamental principle of lending is being violated? You can answer in the comment also, or you can do one thing, have a consolidated list of correct answers and just post how many of that was correct. So the right answer in this will be option B, safety. Safety is the prime lending principle, requiring that advances be granted only when repayment ability is assured. The banker must evaluate the capacity, capital, and the character. That is the three C's before giving out a loan or before proceeding on a credit proposal. Ignoring the cash flow appraisal breaches the prudence and increases the credit risk as reinforced by the RBI's loan policy guidelines of 2023. Coming to question number 2, while considering an overdraft limit for an exporter with irregular past performance, the sanctioning officer must prioritize which lending principle before approving the facility. Is it profitability? Option B, liquidity. C, safety and character of the borrower. Or D, the diversification. Which one of these will be the answer while considering an overdraft limit for an exporter with irregular past performance? The word to be watched out is irregular past performance. The sanctioning officer must prioritize which lending principle? Is it profitability, liquidity, safety and character of the borrower, diversification? So the answer will be C, safety and character of the borrower. The character of the borrower or his willingness to repay is as vital as his capacity. So as per Section 5B of the BR Act, banking is defined as accepting deposits for lending or investment. So lending prudence demands examining the integrity and past conduct. Ignoring this converts business risk into a moral hazard. So question number 3 is, a manufacturing company seeks both a term loan for machinery and a cash credit limit for working capital. This exemplifies which combination of the credit facility? Is it only fund-based? Is it non-fund-based facilities? Is it off-balance sheet commitments or a deferred payment obligation? In this case, both the term loan and the cash credit limit are fund-based. So the answer is option A, only fund-based. Term loans and cash credits involve direct fund deployment. Hence, they are fund-based. So non-fund-based facilities are like the letter of credit and the bank guarantees that are given by the banks, which create a contingent exposure. Coming to question number 4, a partnership firm approaches the bank for a working capital facility. Before the sanction, the banker must verify the firm's authority to borrow as per which of these acts? Is it the Partnership Act 1932? Is it the Companies Act, the Contract Act, or the Negotiable Instruments Act? So when a partnership firm is approaching, you have to go for the Partnership Act. And the right answer will be option A. Section 19(2)(b) of the Partnership Act restricts partners from borrowing unless empowered by the partnership deed. So this is what you should be verifying, whether the partner has been empowered by the partnership deed. The bank must obtain a certified copy of the deed and a borrowing resolution to prevent ultra wires lending and future recovery disputes that may happen. So, as per the Partnership Act, Section 19(2) of B, there is this thing that empowerment by the partnership deed for borrowing. Question number 5. A minor is included as a partner in a firm receiving the credit. How does this affect the enforceability of the loan? Loan is fully binding on the minor. Loan is void ab initio for all. Minor is not personally liable. His share is liable. Or option D, minor becomes jointly liable with the others. So whenever there is a case of a minor is never personally liable. So the right answer will be option C. Minor is not personally liable, but his share is liable. Under Section 30 of the Partnership Act, a minor admitted to the benefits of the partnership has limited liability. The bank can recover only from his share in profits, but not his personal assets. So this underlines the importance of verifying the legal capacity of every borrower who is constituted in a partnership. So the right answer is C. Coming to question number 6. When a publicly limited company borrows, the bank must ensure creation and registration of charge with which of these? The SEBI, the ROC, the RBI, or the registrar of the firms. When a public limited company borrows, the bank must ensure creation and registration of charge with SEBI, the ROC, the RBI, or the registrar of firms. As per Section 77 of the Companies Act 2013, it mandates registration of every charge within 30 days. Otherwise, the security is void against the liquidator and the creditors. So, bank must obtain Form CHG1 acknowledgement from the registrar of companies before the disbursement of the loan. So, the right answer will be option B. The registrar of companies within 30 days under Section 77 of the Companies Act 2013. Question number 7. A bank issues a letter of credit on behalf of a client who is importing machinery. This exposure is categorized as what? Is it a fund-based loan, a non-fund-based credit, a term loan, or a bridge loan? As discussed earlier, a letter of credit represents the bank's contingent liability. So when it comes in a contingent liability, it is a non-fund-based credit. So funds move only if the documents are presented currently. They are non-fund based facilities, which is normally governed by the UCPDC 600 and RBI's master direction on the export and import credit of 2023. Coming to question number 8. A borrower pledges warehouse goods to secure a cash credit limit. The ownership remains with the borrower and possession with the bank. This arrangement is legally termed as what? Is it hypothecation, assignment, pledge, or mortgage? If you go through the question once again, you have the answer in the question itself. So the right answer will be pledge. Under Section 172 to 179 of the Contract Act 1872, pledge transfers possession but not the ownership of the company or product or whatever the thing is. The bank becomes pawnee and can sell goods on default after notice. So what is hypothecation? What is the condition in hypothecation? The owner still has the building or the vehicle. Whenever there is a car loan or a auto loan, what happens is that the car is hypothecated to the bank, but it is owned by the borrower, but it is hypothecated to the bank. Coming to question number 9. In assessing a proposal for working capital finance, the banker analyzes holding periods of raw materials, WIP, that is a work in progress, and receivables. The method applied here is of what kind? Is it cash flow projection, operating cycle method, the net worth analysis, or the current ratio method? What is being used here? Is it cash flow projection, operating cycle method, net worth analysis, or the current ratio method? Whenever there is a question on working capital finance, and when raw materials, work in progress, and receivables are being mentioned, so automatically there is a period from purchase of raw materials, manufacturing of a thing, selling it, and then receiving the money. This is the operating cycle method. So the right answer will be option B, operating cycle method. Operating cycle assessment determines how long the funds stay locked in the production before realization of it. Shorter cycle means higher liquidity. RBI's two committees, that is the Tandon and the Naik committees, methods link working capital eligibility as per the cycle length and they also tell what's the margin required for the loan or the credit facilities. Coming to question number 10. A bank refuses an advance to a customer whose proposed business is speculative commodity trading. Which lending principle supports a bank's decision? Is it liquidity, profitability, purpose, or the security? Is it liquidity, profitability, purpose, or security? The right answer in this case will be purpose, wherein purpose ensures that the borrowed funds are used for legitimate productive activities, generating the repayment capacity. Advances for speculative purposes violate RBI's fair practice for the Code of Lenders 2021 and the ethical banking standards that demand responsible credit deployment. Coming to the next question, a bank examines the projected financial statements of a manufacturing company to ensure that future cash flows can service both interest and principal. This process is known as what? Credit monitoring, credit appraisal, risk review, or portfolio analysis. Whenever we are going for a new credit and we are going to check the future cash flows, what do you check and how is it done? It is done by the process of credit appraisal. So credit appraisal precedes sanctioning and assesses the viability, profitability, and the repayment capacity. It includes the technical, financial, economic, and the managerial evaluations for the purpose. This principle ensures the safety of the fund and is mandated under the RBI's credit risk management framework also for all lending institutions. Question number 12. While assessing a new project, the banker calculates the internal rate of return, that is the IRR, and compares it with the cost of capital. This technique evaluates what? That is, assessing a new project, the banker calculates the IRR and compares it with the cost of capital. This technique evaluates which of these? The liquidity position, the profitability of an investment, the leverage effect, or the working capital required. In the case of IRR, it is a discounted cash flow method for projected appraisal. A project is viable only if the IRR or the internal rate of return is greater than that of the cost of capital. So RBI and IBA recommend such ratio-based analysis for term loan appraisals to ensure economic soundness and prudent capital allocation. So what will be the answer for this? Is it liquidity position again, profitability of investment, leverage effect, or the working capital requirement? And the right answer is profitability of investment. Option B, profitability of investment. Question number 13. In assessing working capitals, the Naik committee model stipulates that eligible bank finance for small units is what percentage of the projected sales or the working capital or current assets? Is it 25% of projected sales? Is it 20% of the projected sales? Is it 25% of the working capital gap, the WCG, or the 75% of the current assets? The Naik Committee of 1991. So, which one of this will be the answer? As per Naik Committee 1991, the working capital assessment for units with turnover of less than or equal to 5 crore, the bank finance is always 20% of the projected annual turnover. That is 20% of the projected annual turnover. So the right answer will be option B, 20% of the projected sales. It enhances ease of credit access to MSMEs while maintaining the margin of safety for the lenders also. We are discussing about Naik committee now. And the next question, here it's the Tandon committee. The Tandon committee's second method of lending requires the borrower's contribution to current assets, that is the net working capital, to be at least what percentage of the current assets? Is it 10, 15, 25, or 30? The Tandon Committee of 1975 recommended they had two methods, and as per method 2, it stipulates that the borrower finances 25% of the current assets from their long-term sources. So this ensures greater liquidity, discipline, and borrower stake. It remains the base for many modern credit risk models also. Coming to question number 15, a banker assesses whether the projected current ratio post sanction would remain at least 1.33 is to 1. This ratio primarily measures what? A banker assesses whether the projected current ratio. What is a current ratio? That is the main thing. What is a current ratio? Current ratio is the current assets divided by the current liabilities. So this ratio primarily measures what of this? A profit margin, the liquidity position, the solvency, or the debt service capacity. What? A minimum of 1.33 ensures cushion against working capital stress. So RBI's lending guidelines and the credit monitoring arrangement format rely on this benchmark to test the liquidity prudence before the sanction of a credit or a loan. So in this case, the answer is the liquidity position of the customer. Question number 16. For a term loan appraisal, the banker ensures that the debt service coverage ratio, DSCR, is consistently above 1.5. This indicates what? You can see the answer. It's borrower's repayment capacity. What is this? Borrower's repayment capacity. So DSCR is the net operating income divided by the principal plus interest that the customer has to pay. Net operating income divided by principal plus interest. So it ratio above 1.5 denotes adequate cash flow to service obligations. It's a key measure under the RBI's Project Finance Guidelines of 2020 and an integral part of the credit risk assessment. Coming to question number 17, You have the answer again. When a bank determines working capital needs using the operating cycle concept, which factor shortens the cycle and reduces the finance requirement? It is a faster collection from debtors. Why? A shorter collection period improves liquidity, reducing the working capital needs. So, we can show how the improved debtor management boosts cash flow and credit rating. Always a faster collection from debtors. So, a shorter collection period improves the liquidity and reduces the working capital needs. Question number 18. A borrower's fixed assets to long-term liabilities ratio is 1.8021. And this indicates what? Is it overcapitalization? It is fixed assets to long-term liabilities. Is it overcapitalization? Conservative financing? Over dependence on the short-term funds? Or asset underutilization? Which of this is the answer? A ratio that is more than 1 signifies that long-term sources finance fixed assets and part of the current assets. Long-term sources are from finance of the fixed assets and part of current assets, reflecting strong financial discipline of the borrower. This aligns with the prudential principle of matching maturities, that is long-term funds for long-term assets. So the right answer is conservative financing. Question number 9. The banker uses sensitive and scenario analysis during the credit appraisal to evaluate what? Effects of changes in key assumptions on the project, borrower's repayment track record, statutory compliance risk, or the loan documentation adequacy. Sensitive analysis tests how project viability changes under the adverse conditions. So sensitivity analysis tests how project viability changes under adverse conditions. For example, the cost, the price changes, or the cost overruns that happens. So it ensures credit decisions are robust against uncertainty. A practice recommended again by the RBI's Project Risk Management Framework. So the right answer here is effects of changes in key assumptions on the project viability. Question number 20. A company's projected sales are rupees 100 crores with a current asset of rupees 40 crores and current liabilities of 20 crores. As per tandem method, what is the borrower's minimum contribution to the current asset? So how about calculating that? We had earlier discussed about the same thing also. Tandem's method 2. Tandem's method 2 says that it should be 25% of total current assets. So what the answer will be 25% of 40 crores. And the right answer is option C, which is 10 crores. Thus, maximum permissible bank finance is 30 crores. So 10 crores is to be brought by the company itself, and the bank will be giving a loan of 30 crores. This problem integrates to the working capital need calculation as per tandem method 2. Coming to the case study. In this, we will be discussing 5 questions from this case study. Measures Neelagan Textiles Private Limited, a garment manufacturer, has applied for enhanced working capital limits from 6 crore to 10 crore with your bank. The company operates on a 3-month operating cycle and has a good track record and maintains a current ratio of 1.35 to 1. The firm provides CMA data showing current assets of 12 crores and the current liabilities of 5 crores. So the current asset to current liability is 12 by 5. The sanctioned limit, which include a cash credit facility, a bill discounting limit, and an inland letter of credit facility. So based on the data, what is the maximum permissible limit of bank finance under the Tandem's committee method? 2. Here the question is, what is a MPBF? It's not what is the margin. So the MPBF is 30 is to be calculated. So under this method, the borrower's contribution should be 25% of the total current assets. So what is the current asset? The current asset is 12 crore and 25% of 12 crore is 3 crore. So the maximum permissible limit is the current asset minus the current liability plus the borrower's contribution. So what is the current liability? The current liability is 5 crore and the borrower's contribution is 3 crore. So that makes it a total of 8 crore. And the current asset is 12 crore. When you reduce the total 8 crores from 12, you get it as 4 crores. Since existing limits already stand at 6 crore, the bank can sanction enhance only after revalidating projections and ensuring justifiable working capital gaps. The principle of safety applies: no finance beyond justified needs. So if there is a enhancement of income, only in that case it can be done. So the right answer here is 7 crores. The second question in the case study, if the firm's projection turnover is 50 crores, the required working capital limit under the NIC committee guidelines would be 5 crore, 7 crore, 10 crore, or 15 crore. Under the NIC committee's method, for MSMEs with turnover less than 5 crore, extended proportionally in practice, bank finances 20% of the projected turnover. Here 20% of 50 crore is rupees 10 crore. This simplifies the small unit funding and encourages turnover based lending. So the right answer for this will be 10 crore. Question number 23. The bank plans to grant a sublimit of 3 crore under the inland letter of credit. This facility represents what? A fund-based exposure, a non-fund-based exposure, part of term loan, or a deferred payment gratuity. Inland letter of credit. These kind of commitments create the contingent liabilities, wherein the banks promise payment to the suppliers upon presentation of the compliant document after the delivery of the product. So no funds are disbursed unless the LC is invoked, unless the letter of credit is invoked. So this is a non-fund based exposure. Option number B, non-fund based exposure. Coming to question number 24. Assuming the company's operating cycle extends from 3 months to 5 months, the immediate impact on the working capital requirement will be what? When the operating cycle increases from 3 months to 5 months, the immediate impact on the working capital requirement will be what? Reduction in working capital, increase in working capital, no change, or depends on the current ratio only. What is it? Whenever there is a longer operating cycle, the funds are locked in for the raw materials, for the work in progress, and receivables for a longer period, which increases the working capital needs. So the bankers should review the projections and stock statements to reassess the drawing power. This emphasizes continues the credit monitoring and dynamic reassessment also for the bankers. So whenever there is a extension of the working cycle or the operating cycle, there is an increase in working capital also. So the right answer is option B, increase in working capital. Question number 25. To ensure post-sanction discipline, the bank mandates submission of monthly stock statements. The key purpose of this is for what purpose? To update the customer turnover data, to compute drawing power based on actual stocks, to verify the borrower's profit margin, or to revalidate the term loan projections. What's the purpose? I'm sorry. Stock statements help the bank determine the drawing power of the customer. So what is drawing power? Drawing power is the eligible stocks plus receivables minus the margin that is being put by the borrower. They also aid in early identification of irregularities and the overdrawals from the cash credit or the loan. So the right answer here is to compute the drawing power based on the actual stocks. Coming to question number 26. A bank extends a secured advance against a immovable property owned by the borrower. The security interest becomes the legally enforceable only when it is created by what? A pledge, a hypothecation, mortgage by deposit of title deeds, or the assignment. When is the security interest becomes legally enforceable? When it is created by what kind? Pledge, hypothecation, mortgage by deposit of title deeds, or the assignment. As per Section 58F of the Transfer of Properties Act, a mortgage by deposit of title deeds, that is an equitable mortgage, transfers an interest in the property without registration, provided deeds are deposited in the notified towns. So the right answer here is the mortgage by deposit of title deeds. Question number 28. An exporter obtains a guarantee from the banks ensuring performance of contractual obligations. This is classified as what kind? Financial guarantee, performance guarantee, statutory guarantee, or the deferred payment guarantee. An exporter obtains a guarantee from the bank ensuring performance. Guarantee from the bank ensuring performance. So the right answer is performance guarantee. A performance guarantee covers non-financial obligations like delivery or project completion. Such instruments require margin, security, and the board approved policies also. Coming to question number 29. A bank sanctions a housing loan secured by equitable mortgage of flat property. The loan agreement and mortgage deed together form what? A independent contract, composite loan documentation, irrevocable power of attorney, or a continuing guarantee. Is it an independent contract? Is it a composite loan documentation, irrevocable power of attorney, or a continuing guarantee? And the right answer here will be it is a composite loan documentation. Loan documents collectively constitute one enforceable contract. That is a loan agreement plus security document plus the DPN or the demand promissory note. Proper stamping and execution are vital for the admissibility under Indian Evidence Act 1872. So the right answer is composite loan documentation. Question number 30. In case of default, a banker selling pledged quotes without reservable notice to borrower violates which legal principle? The bailment rights, the banker's lien, Pawnee's right of sale under Section 176 of Indian Contract Act, or the hypothecation rights. Bailment rights, banker's lien, the pawnee's right of sale or the hypothecation rights? And the right answer is C. Section 176 of the Contract Act mandates reasonable notice before the sale of pledged goods. Failure renders sale voidable and exposes the bank to the damages also. Which one of the following is not a valid mode of charging securities? Is it hypothecation or mortgage, lien, or a guarantee? It's not a valid mode of charging securities. In mortgage, you do charge. In hypothecation, you do charge. In lien, also you do charge. And in guarantee is a contractual undertaking. It's not a charge. It's a contractual undertaking and not a charge. A charge creates an interest in the property as per the Companies Act 2013. So the right answer is guarantee. Question number 32. Under the Indian Contracts Act 1872, the right of an indemnity holder to recover expenses from the promisor arises under which section? Is it section 124, 125, 126, or 128? The right of an indemnity holder to recover expenses from the promisor arises under which section? As per section 125, it details the indemnity holder's right to recover costs, damages, and the sums paid. So, banking contracts like letters of indemnity for duplicate drafts are governed by these provisions. So, the right answer is section 125. Question number 33. In a continuing guarantee, if one co-surety is released by the creditor, the liability of the remaining sureties become extinguished, reduced proportionately, it's unaffected, or it is transferred to the borrower. If one co-surety is released by the creditor, the liability of the remaining sureties become what? Is it extinguished, reduced proportionally, unaffected, or transferred to the borrower? As per section 138 of the Contracts Act, again, discharge of one co-surety does not discharge the others. So this ensures the creditor protection. So the answer in this will be it remains unaffected. Coming to question number 34. Under UCPDC 600, this is regarding the letter of credit, an issuing bank must honor a complying presentation under a letter of credit within how many banking days? Is it 5 days following the day of the presentation? Is it 10 banking days? Is it 3 working days, or immediately on site? An issuing bank must honor a complying presentation under a LC within how many days? As per Article 14B of UCPDC 600, it allows a maximum of 5 banking days for examination of documents for each and every bank. Deferred payment guarantees are primarily issued for what purpose? Commodity trading, capital goods purchase, working capital borrowing, or a non-resident remittance. For what purpose are deferred payment guarantees primarily issued for? The deferred payment guarantees cover installments for imported or indigenous capital goods. They are substitute supplier of credit and are treated as financial guarantees also for capital adequacy computations. So the right answer is capital goods purchase. Question number 36. A bill drawn by the seller on buyer, accepted by the buyer, and discounted with a bank is known as a bill drawn by the seller on the buyer, accepted by the buyer, And discounted with the bank is known as a demand draft, a trade bill, a accommodation bill, or a treasury bill. What is it? A demand draft, trade bill, accommodation bill, and treasury bill. When there is discount, it cannot be a demand draft or a treasury bill. And accommodation is something else. So the right answer here is a trade bill. Trade bill arises out of genuine sale of goods, and accommodation bill arises out of ingenuine sale of goods and are negotiable under section 5 and 6 of the Negotiable Instrument Acts. So trade bill are coming under section 5 and 6 of the Negotiable Instrument Act of 1881. Discounting provides short-term finance and liquidity to the sellers also, which forms part of banks and bill finance operations. So trade bills are used for a genuine sale of goods. Priority sector lending targets for domestic commercial banks require that total priority sector lending advances constitute at least what percentage of ANBC or the NDTL or total credit. ANBC is adjusted net bank credit. Is it 35%, a 40%, 45%, or a 10% of total credit? As per RBI's master direction on PSL, it mandates 40% of adjusted net bank credit as an overall target. Sub-targets apply for agriculture, MSME, and weaker sections also. So the answer here is it's 40% of adjusted net bank credit. Question number 38. A Kisan credit card issued under the revised scheme serves primarily as what? A term loan instrument, revolving cash credit limit, short-term deposit, or a subsidy certificate. What is a KCC, or what is KCC issued under the revised scheme serves? Is it a term loan instrument, revolving cash credit limit, short-term deposit, or a subsidy certificate? KCC provides farmers a revolving limit for crop and allied activity needs. So it aligns with the priority sector, that is the agricultural norms, and integrates with the PM Fasal Bima Yojana for the risk coverage also. So KCC, in this case, the right answer will be revolving cash credit limit. Question number 39. Under the MSMED Act 2006, delayed payments to micro or small enterprises beyond 45 days attract interest at what rate? RBI's repo rate, 3 times the bank rate, prime lending rate, or 2% per month. And the right answer will be the 3 times of the bank rate. Section 16 of the Act says the 3 times of the bank rate, that is compounded monthly. 3 times of the bank rate, that is compounded monthly. Question number 40. Under RBI's co-lending model, the minimum share of credit risk to be retained by the bank in each co-lending exposure with an NBFC is 10, 20, 25, or 40%. The minimum share of credit risk to be retained by the bank if it is co-lending with an NBFC. Is it 10%? Is it 20%, 25, or 40? Co-lending mandates a minimum of 20% risk share by the bank. NBFC originates and services loans. This promotes priority sector flow while maintaining the prudence also. So the bank should have a minimum of 20% risk share. And the right answer is option B. Question number 41. Advances against shares are governed by RBI's capital market exposure norms, limiting finance to individuals up to what amount? Option A 5 lakh, option B 10 lakh, option C 20 lakh, or option D 50 lakh. Advances against shares are limited to what amount? It is restricted to an amount of rupees 10 lakh for individuals to curb the speculative lending. So you can take advances against shares for an amount of maximum 10 lakh rupees. When lending against goods under hypothecation, the greatest risk faced by the bank is market price fluctuation, moral hazard due to borrower's possession, high storage cost, or the legal enforcement. Which of this is the right answer? Market price fluctuation, moral hazard due to the borrower's possession, high storage cost, or the legal enforcement. So in the case of hypothecation, it's the borrower who is possessing the vehicle or anything that has been hypothecated. So since possession remains with the borrower, the bank relies on trust and the control statements. So continuous inspection and insurance are mandatory for these. So the right answer is option B, moral hazard and due to the borrower's possession. In a guaranteed contract, consideration is satisfied only if surety receives commission, creditor advances loan to principal debtor, borrower pledges a security, or the guarantee is executed on a stamp paper. In a guarantee contract, consideration is satisfied if the surety receives the commission, creditors advances the loan to the principal debtor, borrower pledges security, or guarantee is executed on stamp paper. So as per section 127 of the Contract Act, anything done for the principal debtor's benefit suffices as a consideration for the surety. So the right answer here is creditor advances loan to the principal debtor. Question number 44. A bank issues a letter of credit incorporating confirmed status through another bank. The confirming bank's role is to what? Advise only, add its own undertaking to pay, negotiate documents without recourse, or act as a reimbursing bank. In this case, a confirmed LC means the confirming bank adds its irrevocable payment commitment, sharing risk with the issuing bank. So it adds its own undertaking to the payment to be done. And the right answer is option B. Question number 45. When a borrower defaults on a co-lending loan, which entity initiates recovery proceedings? Is it the NBFC only, bank only, as per mutually agreed arrangement in co-lending agreement, or the RBI directly? When a borrower defaults on a co-lending loan, which entity initiates the recovery proceedings? Will it be done by the NBFCs only, by the banks, or as per the mutually agreed arrangement, or RBI directly? So co-lending agreements define recovery responsibility. Typically, the NBFC services and initiates action on behalf of the both the parties. So as per mutually agreed agreement in the co-lending agreement. Coming to case study number 2. This will be the last set of questions. There will be 5 questions more. If you are still in this video, I wish that you give me a thumbs up and share the video to your friends who are preparing for JAIIB exams. Measures Arnav Engineering Limited was sanctioned a term loan of 20 crore for machinery purchase and a working capital limit of rupees 5 crore under consortium banking. Due to a major fall in exports and liquidity crunch, the account showed irregularities for 95 days. Interest was not serviced for 2 quarters. The lead bank must now classify and initiate the corrective measures in this case. So, as per the current RBI guidelines, when should this account be classified as an NPA? When principal or interest remains overdue for more than 60 days, when principal or interest remains overdue for more than 90 days, when the company's turnover declines continuously, or when consortium members disagree on the recovery action. So, what will be the right answer? What is an NPA? When principal or interest remains overdue for more than 90 days, that account is mentioned as an NPA. So, the right answer will be option B. So, as per RBI Master Circular on the prudential norms of income recognition and asset classification and provisioning, an asset becomes NPA when interest or installment remains overdue beyond 90 days. Coming to question number 47. Once classified as an NPA, interest accrued but not realized should be taken to income account, shown under the contingent income, reversed or not recognized till realized, or carried forward as accrued interest. Income recognition must be on the realization basis for the NPAs. So RBI's prudential norms prohibit accruing unrealized income to prevent inflated profits. So the right answer here will be reversed or not recognized till realized. Question number 48. Under SARFAESI Act 2002, after classifying an account as NPA, what is the minimum notice period before taking possession of the secured assets? After classifying an account as NPA under the SARFAESI Act, what is the minimum notice period before taking possession of the secured assets? Is it 15 days, 30 days, 60 days, or 90 days? Section 13(2) of the SARFAESI Act mandates some particular day to the borrower to discharge dues before taking possession. And the right answer is it's 60 days. Section 13(2) of the SARFAESI Act mandates 60 days notice to the borrower. Only after this period can the bank invoke the section 13(4) for the possession or sale of the property. Question number 49. If recovery through SARFAESI fails and insolvency proceedings are initiated under the IBC 2016, who can file an application before the NCLT on behalf of the bank? I say the borrower's auditor, the authorized officer of the bank, the recovery agent, or an external auditor. Is it the borrower's auditor, the authorized officer of the bank, the recovery agent, or the external auditor? And the right answer here will be under Section 7 of the IBC 2016, a financial creditor, that is including a bank, can file an initiation of insolvency against the corporate debtor through its authorized officer. So the right answer is authorized officer of the bank. Coming to question number 50 and the last question of this video or module B. If after liquidation, the realized amount does not fully satisfy the bank's dues, what is the accounting treatment for the shortfall? transfer to general reserve, write off or provisioning as per RBI norms, carry forward indefinitely, or recover from the guarantor. Is it transferred to the general reserve, write off or provisioning as per RBI norms, carry forward indefinitely, or recover from guarantor? RBI requires banks to make provisioning or write off of uncollectible amounts based on the asset classification itself, whether it is a substandard or doubtful or loss. So, in this condition, the right answer will be write off or provisioning as per the RBI norms. I think this video was fruitful for you. Please do like, share, and subscribe the channel. Brilliant Bankers. This is Nishant signing off. Jai Hind.